Hey everyone, the big question on everyone's mind is this crypto bull market finally ending? Some folks think it'll stick around until 2026, others say it's over by the end of this year, and a few are even betting on a super cycle thanks to all the money printing. Well, today we're figuring out when this party might stop, what could crash it, and just how low things could go. Stick around because you won't want to miss this. Now, to get started, you need to understand how crypto markets usually work. They typically follow a 4-year rhythm, about 1 to 2 years of a bull market, where prices surge, followed by 2 to 3 years of a bear market, where things cool down. Bitcoin usually leads the charge, and other cryptocurrencies catch up later, with the biggest gains often happening right before the bull market tops out. Here's the tricky part. No one fully agrees on what officially starts a bull market or a bear market. Some say a bull market begins when Bitcoin hits its lowest point. Others wait until Bitcoin sets a new all-time high. For us, we look at something called the Bitcoin halving as our key reference point. Historically, Bitcoin's price peaks about 16 to 18 months after one of these halving events. The most recent halving happened in April 2024. So based on history, that puts our potential market peak somewhere around August to October this year. When it comes to spotting a bear market, simply seeing a 20% drop in Bitcoin doesn't cut it. Bitcoin can do that in a bull market and still recover to new highs. Instead, we use a special line on a monthly chart known as the Bollinger Band moving average. When Bitcoin is above this line, it's generally in a bull market. When it's below it, that's often the start of a bear market. This same indicator works for the total value of the entire crypto market and even for smaller cryptocurrencies. Right now, that special line for Bitcoin is sitting at around $82,000. The total value of the entire crypto market has its line at around $2.7 trillion. So we could see prices drop to those levels and still technically be in a bull market, meaning a recovery and new highs are still possible. But here's where it gets interesting. For the smaller cryptocurrencies, their special line is at about $250 billion. Their current total value is around $280 billion. That means there's only about 10% wiggle room before these smaller cryptos are officially in a bear market. They even dipped below that line temporarily earlier this year, which could be an early warning sign that a broader downturn is getting close. Remember, these smaller cryptocurrencies are typically the last to skyrocket in a bull market and the first to crash when a bear market hits. Waiting for prices to fall below these lines isn't the best strategy, though. By then, you've already seen a big drop. So, what else can you watch? The Relative Strength Index, or RSI, also on a monthly chart. If the RSI hits a really high overbought level, like between 80 and 90, and prices start to slip below shorter-term key levels, there's a good chance the top is in and the bear market is starting. Now, a big crash that kicks off a bear market is usually triggered by a major negative event. Think back to 2017 when South Korea talked about banning crypto exchanges, or in 2021 when the Fed hinted at raising interest rates. These events can send prices tumbling. This time around, there are plenty of possibilities, but the most impactful will likely be something no one expects and something that hasn't been priced into the market yet. One example could be if the Treasury Department decides to require strict ID verification for all transactions involving stablecoins. Another might be if the U.S. puts new tariffs on China or if tensions between China and Taiwan escalate. But here's the kicker. These headlines don't cause the crash. They just make it worse. The real culprit is something called leverage. Leverage is when people borrow money to make bigger bets. When a market starts falling, these leverage positions get liquidated, meaning they're forced to sell, pushing prices down even further. This happens on regular exchanges, but it's even more dangerous in decentralized finance, or DeFi, and centralized finance, or CeFi. These liquidations are often much larger and can lead to prolonged automatic selling pressure as lenders try to get their money back. The problem is, near a market top, everyone has usually taken on as much leverage as they can. Traders have maxed out their credit cards, investors have maxed out their crypto loans. When a negative headline hits, this cocktail of liquidation starts pushing prices down, and there's no money left for anyone to buy the dip. This cycle could be even worse because now we have huge institutions and crypto treasury companies holding billions in Bitcoin and other cryptos. If prices fall, they'll face immense pressure and could be forced to sell, creating even more automatic selling pressure with no one to step in and buy. When selling is robotic and automatic, traditional technical analysis, which usually measures human emotion, might not even work to find the bottom. So, how low could prices actually go? That's really tough to estimate because it depends on how bad the negative events are and how much leverage gets wiped out. But we can look at a couple of scenarios. In a normal bear market, consistent with past cycles, Bitcoin has historically never fallen below its previous cycle peak. Bitcoin's last peak was around $70,000. So in the next bear market, it's likely that Bitcoin's bottom would be somewhere around $70,000, give or take about $10,000. That give or take accounts for people buying early because of history or extra liquidations pushing it lower. For most smaller cryptocurrencies, they tend to fall about 90 to 95% from their highs. So if Bitcoin hits $70,000 and one of your smaller coins is down 95%, it's probably pretty close to its bottom. But what if we get a really nasty combination of negative events and liquidations? This is a scenario we believe is only a matter of time. Crypto has been growing for over a decade, and the amount of leverage in the system is increasing, possibly creating risks for other markets too. In this uncharted territory, Bitcoin would likely fall well below $70,000. A collapse of that scale would probably lead to intervention from authorities, whether through printing more money or new regulations. While more money printing could be good for crypto long term, regulations would certainly change the landscape for the projects and companies that survive. The market would look very, very different next time the bulls come around. But saying this time is different is one of the most dangerous phrases in investing. While the details change, the core market cycles often stay the same. On balance, we're likely heading for a more standard garden variety bear market after this bull run. Understanding these dynamics will make it much easier to navigate the turbulent times ahead. All right, that's it for today. If you found this helpful, make sure you hit that like button, subscribe to the channel, and ping that notification bell so you don't miss our next video. Thanks for watching, and I'll see you next time.